Hello, and welcome to our last part of our federal tax law training, Part 5, covering credits, both refundable and non-refundable credits, as well as other taxes. This is for VITA Services for West Michigan, and my name is Amanda Grover. I'm the Tax Program Coordinator here at Goodwill Industries of West Michigan. So, as I've been doing in the previous modules, I'd just like to give you an overview of where we're at. We've covered a lot of the information on the tax return already, so we're at our last part. We've covered page 1, and now we're in the tax and credit section. On our previous module, we had just determined the amount of tax that's going to be due for the taxpayer, but this is only before the tax credits are applied. So today we're going to look at our refundable tax credits as well as our non-refundable tax credits. First, we're going to start with our non-refundable tax credits. So aren't all credits the same? They're really not. So there's a difference. I just indicated and have just been talking about non-refundable tax credits. So tax credits are broken down into two different categories, refundable and non-refundable. If you have a non-refundable, it's a good thing to have, it's a good credit, but it doesn't generate a refund. So you can't go any lower than $0. Basically, a refundable credit means the credit cannot be used to increase the tax refund. It doesn't exceed the amount that is owed, or it doesn't exceed zero. However, if a person is eligible for a refundable credit, that basically means that the refundable credit is treated as a payment of tax, and if the total is greater for the credit than what's owed in tax, then the taxpayer can receive the difference and the IRS would then refund the taxpayer. Let's kind of see how this works. It's a little bit easier to explain with an example. So, say you have a child tax credit that's non-refundable for $500. Or say you owe a tax of $500 and then you're eligible for a child tax credit that's non-refundable for $600. Even though the credit is worth $600, because the amount owed is only $500, you don't receive any sort of refund for that. So you don't go above what's owed in tax. So the refund would then be at $0. However, if the person has the tax due and they're receiving a refundable earned income tax credit of $600, the $600 would go first towards the tax and reducing that down to zero, but then the $100 that's left over becomes a refund for the taxpayer. So some of the non-refundable credits include foreign tax credit. We don't see a lot of that at all. I wouldn't worry too much about that. The child and dependent care credit, those are for child care expenses, and it can only be eligible for somebody if they're going to work. We'll go through some of the credits in more detail, but I like to give an overview and a scope. There's education credits if you attend college or higher education. There's the retirement savings contribution credit. This is automatically calculated in the software, so it's not anything you have to calculate or enter any information on. But that's if somebody contributes to a 401k or some sort of retirement savings. This is automatically, again, generated from the W-2, so that's why it's so important to make sure when you're entering income information that you're doing it correctly. And then the child tax credit. There's a refundable portion and a non-refundable portion. So we're going to talk first a little bit about the non-refundable portion. And that's for raising any children that are ages 17 and below in the home. So we're going to go into a little bit of detail about these non-refundable credits. Again, your 4012 resource guide has some really good information in case you ever have to refer to it. It's broke down in a very easy to read manner, but I'm going to review the information with you through this module. So a child dependent care credit is eligible for somebody who has to work and has to have their child care covered, and they have to pay out of pocket. So it's calculated based off of income as well as the amount paid. You can go to the child care credit on line 49 and you'll open up this form, and it's going to ask for some just basic information. Somebody that's coming in to claim this credit, they oftentimes are very aware of it and come with this information, but the call 211 call specialist also reviews some of this information with the client. So the client has to come in. There's not one specific form they're going to have, so they're going to have to obtain this information from their child care provider. if their child goes to a child care provider that sees this a lot or that has kind of a large business, they automatically know to provide these to parents. But sometimes parents have to ask the child care provider for this information come tax time. But they have to come with the child care provider's name, the provider's address, phone number, and either the provider's tax ID number, so basically the thing that's similar to the employer ID number, or a social security number for that provider. The thing that the child dependent care credit does not cover is anything like an overnight camp or any sort of tuition that they've paid to a kindergarten or preschool or school in any way. It has to be directly to a child care provider. So typically this is just in place to allow the head of household or the single pardon me, or both of the parents to work. So if a person if we're in a home and the mother's a stay-at-home mom, but sometimes has her child go to childcare so she can do some errands and so that the child can socialize, that will not count. It can only be counted if the child is going to daycare so that the parent or parents can work. The form that will come up on line 49 when you go to fill out this information is called Form 2441. That's just for your reference. You don't have to memorize that. It's not going to be a huge thing that you're going to have to remember for entering information. Next, we have some education credits. So these can get a little bit tricky, but we're going to break them down, and I'm going to start with some basic information. If somebody attends a college institution or a higher learning institution, they can go for what's called the American Opportunity Credit or the Lifetime Learning Credit. The American Opportunity Credit is most advantageous because the credit is a little bit larger. The American Opportunity Credit is worth up to $2,500, whereas the Lifetime Learning Credit is only worth up to $2,000. There's a couple of caveats with the American Opportunity Credit, and we'll go through that information in detail. But I just want to cover first the form that the student will receive. So the first thing that we want to determine is if a person is eligible for an education credit. And we can determine this by first looking at their 1098-T. So there's two boxes that I really want to focus on in this training and make sure that you get a good understanding. First, somebody will come in with a 1098-T. It should basically always look like this with a little bit of, it might change in color or size a little bit, but it should be set up just like this. It'll have the university or establishment's name up here, as well as their ID number, so their federal ID filing number. You'll have to enter that into the software. But the big thing I want you to focus on right now is understanding the tuition that was paid or the tuition that was billed, and then scholarship information. So in this example, the scholarships provided to the student, Noah, were $10,000. You can see that right here in box 5 where it indicates scholarship. So what you do to see if somebody is eligible for the credit is to first apply the scholarship to the tuition amount. So if you subtract the scholarships from what the person paid out of pocket, it's left with $1,800. You can use that $1,800 to try to apply for the tax credit under the right circumstances if the client is eligible. Based on other situations, you can put in $1,800. However, if this scholarship amount and the tuition amount were switched places, so say there was $11,800 right here in the scholarship information, there's nothing you would do with this. There's no education opportunity to, or there's no education credit to apply for. And that's basically because if somebody receives more scholarship than what they were billed, then they're not paying anything out of pocket, and then they're not eligible for any sort of tax credit on that. So I'm going to go through some of the particulars about first the American Opportunity Credit, so you kind of understand what some of those requirements and eligibility items are. So a person can claim what they paid out of pocket, so the tuition, and that's what's on the 1098T. If they paid anything out of pocket for that, and you can, again, you'll see that on the 1098T form. They can, so in our previous example with Noah Swift, we could claim the $1,800 that he paid out of pocket, but the credit can claim up to $4,000. So if there's any books or school costs that are associated with attendance, like books or technology items, then you can apply the cost of those towards the $1,800 as well. So let's say he paid $700 out of pocket during that semester or for that year for books. It would be the $1,800 plus the $700 for books, and that would be a total of $2,500 that he could claim for the credit. So the requirements for claiming the credit is that this must be the pursuit of the first post-secondary degree. And what that basically means is it has to be the student's first bachelor's degree, licensing, or sort of certification. The client or the taxpayer must have been enrolled at least part-time, so 1 semester, and it can only be claimed for up to 4 years. There's a non-refundable portion of $1,500 of the credit, and then there's a refundable portion of up to $1,000. Even amounts that are paid by a loan can be counted. So if a person says, well, I had to take out loan money to pay for the books, that can definitely be used towards this credit. Make sure that the tax filers really understand who's claiming the credit. So sometimes we'll get students coming in to try to claim this credit when really they're being claimed on their parent's tax return. If that's the case, then the parent will want to claim the credit and it'll go on their tax return. And typically this is most advantageous for both parties anyway. If the parent is receiving this credit, they're typically in a position to receive all of the refundable portion of it, and students really aren't usually eligible for any of the non-refundable portion. So it's kind of like wasting non-refundable tax credit dollars. If the payer is, if the taxpayer comes in, or say if it's a parent or if it's a student and they don't have the 1098T form, but they indicated they've attended college, indicate to them that they probably will want to reschedule their tax return because this can equal huge dollars for the person. I would first just have the conversation to see if they paid anything out of pocket or if they had to take out any loans. If that's the case, that's a big indicator that they will be eligible for the tax credit. However, if they indicate that Pell Grants or student aid covered all of their attendance costs, then this isn't really anything that you'll have to wait for any sort of information on. This does get to be kind of a confusing credit only because a lot of people aren't aware of it still, so they don't come in prepared with their 1098T as well as their out-of-pocket expenses. So it's good just to go through the tax credit, make sure that the client understands it. Like I said, a portion of the credit is non-refundable while a portion of the credit is, and the refundable portion is found on line 68 and the non-refundable portion is found on line 50. So that sounds a little bit confusing. If you pull open the form under line 50 and just complete the form, it'll put the proper amounts after you answer all the questions and fill out the information from the 1098T. It'll provide that information on line 50 and 68. The program will automatically calculate it for you. So again, you have to kind of understand where these numbers are coming from, but you definitely don't have to do the math or put in the numbers yourself. Once you're entering information from the forms, the software does it all. It calculates all of the different numbers on the tax form. So then we're going to talk a little bit about that lifetime learning credit. So when you go to that line 50, it'll give you an option on page 2 to either apply for the lifetime learning credit or the American Opportunity Credit. You can try both of them to see what's going to be most beneficial to the student, but if they haven't claimed the American Opportunity Credit for 4 years already, then you're definitely going to want to try the American Opportunity Credit. However, if a person is just coming in because they're trying to improve job skills maybe, or if they are pursuing a post-secondary degree that's maybe their second one, they can apply for the lifetime learning credit. It's a non-refundable credit up to 10% of school expenses, and it's the maximum amount is $2,000. So it can include any sort of education. It might be just a class to improve some sort of job skill or something like that. Some of the things that it includes are tuition, the cost of books and supplies, and it can even amount, and it can obviously be, you can claim anything that's paid by a loan. Again, the taxpayer or whoever's filing the credit should definitely have that 1098-T. Otherwise, it's just like the American Opportunity Credit where it can cause delay. And again, just make sure this is a possible credit for somebody that's still a dependent in a home. So if it's a student and they're being claimed on their parent's tax return, just make sure that you indicate that and that you really have a good understanding as to who's actually eligible to claim the taxpayer and who it's going to be most beneficial to provide the credit to. So this is how it looks. Like I said, you have that 1098-T. You're going to have the student's name right here and their social security number. I indicated that the educational institution information will have to be collected as well, and that just goes right here. This is that 8863 or that credits page that's from that you can open from line 50 in your 1040 form. And then you'll enter just information right off of that 1098-T, so that EIN number that was provided. There's a couple of sections that look just like this in case somebody has information from a couple of different educational institutions. So you can see the name of the second individual. The page goes on to provide, I believe, 2 different spots for any sort of educational institutions. The next part of this page, so this is where it gets kind of tricky, and this is, I bring this up because I wanted to make sure to emphasize that it's important to read through these questions during your training. So it might be a good time right now to pause the module and really read through these questions so you understand them and how they're being asked. At any rate, if you don't take the time to do it now, then I encourage you to do it as you're going through your practice examples through your 4491W and for your certification, and really take the time to read these questions because it's important that you answer them correctly. Otherwise, a credit will not be calculated. The program will just indicate that it's 0, and these questions are not necessarily asked in the most straightforward way. So the first question, has the Hope Scholarship Credit or the American Opportunity Credit been claimed for the student for the past 4 years before 2014? That sounds kind of convoluted. So basically what the question is asking is whether the student has claimed the credit for 4 years. If they're not sure or if they indicate they have, then they're not eligible for these credits. And that's when you want to look at the lifetime learning credit because they're not going to be eligible for the American Opportunity Credit. And these questions are only asked if the person is applying for the American Opportunity Credit. Otherwise, defer to the lifetime learning credit. It's going to ask if the student was enrolled at least half time when they were in college. It's also going to ask if the student has completed the first 4 years of post-secondary education. What it's basically asking there is if the student has claimed the credit or if they have already received a bachelor's degree. Because if that's the case, then they're not eligible for the credit. Was the student convicted? So this is another reason that you may have to defer to the lifetime learning credit. We don't see this a whole lot at our tax sites, but it is one of those questions you have to ask. It asks if the taxpayer has been convicted of a felony possession of a or distribution of a controlled substance. And if they have been, it just means that they're ineligible for the credit and they can apply for the lifetime learning credit, or they can use any of their educational costs as an adjustment. So this is how you put the income in. So if we're using our previous example, the student can claim up to $4,000, but really you're supposed to just be using tuition and expenses that total the amount that the person paid out of pocket. So there's a full list in your 4012 for each credit because they do vary a little bit as to what can be claimed. I would suggest reviewing that information before you jump into any returns or review that information when you get to your first practice example that goes through education credits because you'll want to get familiar with what people can claim for each credit. So for example, it doesn't include anything like a parking sticker, that was paid for out of pocket, or a meal plan that was paid for out of pocket, none of that can be claimed towards the credit. So it's just adjusted qualified educational expenses that can be listed on this line 27 of the Form 8863. And once you put that amount in, the credit will automatically calculate. The program will do everything else. So you don't need to worry about lines 28 through 30. Or if you're just putting in the amount for the lifetime learning credit, you just put in the amount, and again, the credit will be calculated. So you don't have to do any of the math, but you do have to know what to enter. The retirement savings credit, this is a really nice one because the software will automatically calculate it for you. It's for anyone that's a non-dependent, non-full-time student, and they're of adult age in 2015, so they have to be of at least 18 years of age. It can be worth up to $1,000, but I've never seen this tax credit reach that height. And it basically flows from the W-2 form. And so there's nothing you really have to enter. It'll just show up. So just be aware that it's there. If it's calculated, you can explain that it's a retirement credit. It's basically because the person is contributing towards some sort of retirement fund, and there's a credit that they receive based on their income because of that. The child tax credit is one of the big credits we like to talk about and make sure that all of our tax preparers really understand and have a good grasp of. So for any of the qualifying dependents, they have to be 17 years or younger for the taxpayer to be eligible for this. A lot of people have questions and can't wrap their heads around why why the dependents are not eligible for this credit after the age of 17. And that's basically because a person can claim a newborn on their tax return. So they do get to claim the child for 18 years, but it does look like 17 if you're explaining the tax credit to them. It's basically a credit that a taxpayer receives for having any sort of qualifying dependents in their home. So again, making sure that the child or dependent or making sure that the child passes the dependency test, that they're related, that they've lived with the parent for 6 months, or the taxpayer for 6 months or longer, and that the taxpayer provided more than half the support for that dependent. The child must be a U.S. resident, and they must have a social security number or ITIN to apply or to qualify for the credit. They can't have an income of any higher than $3,000. And the tax credit itself, the non-refundable portion is worth up to $1,000. Or I'm sorry, the credit itself is worth up to $1,000. There's a refundable portion that'll first be used to calculate the tax owed down to zero. And then there's a refundable portion. Whatever's remaining from the credit, the taxpayer will receive a portion of that as a refundable credit. So it's both a non-refundable as well as a refundable credit. Again, the software does all the calculation. All you have to do is make sure that you're entering all the dependent information correctly on the main information page when you're first starting the tax return. Some of the other taxes that I like to cover. So there's the self-employment tax that's automatically calculated. So these are taxes that are charged to people. These are not tax credits. These are taxes that people have to pay. So the self-employment tax, that's automatically calculated by the software, as well as any Social Security tax, as well as any tax for people that are receiving a distribution from some sort of investment or retirement. If they withdraw before they're 59 and a half, they have 10% of it that's taxed. So these are automatically calculated. If you've done a Schedule C for someone, they are taxed, and that's called the self-employment tax. If they're receiving a large amount of Social Security income, a portion of that is taxed. And again, if somebody receives that distribution. So that all shows up in the section that we're talking about with non-refundable credits and other taxes. So that's where you'll see this information come up. I do like to talk about the Affordable Care Act because that's covered on line 51. So I like to just mention it right here because this is the section that if somebody is owed, or if they owe, or if the IRS owes them money, if they've received a premium tax credit, that's where this information pops up. We'll go into a lot more detail. There's a whole module on the Affordable Care Act. So I do just want to say that the Affordable Care Act, if there is something that's owed, you'll see it transfer from its worksheet over to this section where there's taxes and credits. So let's jump into some of the refundable credits. There's the additional child tax credit, a portion of educational credits, the premium tax credit, and the earned income tax credit. The earned income tax credit is definitely the biggest credit we want to make sure that you understand and cover in detail. And that's because this is why the whole VITA program was created. It was to make sure that people who are working poor or people who are working are receiving some sort of incentive to work. And it's the largest IRS anti-poverty program, really. It's the biggest amount of money most families receive during the year. So we want to make sure that families are really using this money to work for them and are building assets. So this is where we end up with payments. So this is the best section, my favorite section of the tax return, because we're going through not only what people had withheld from their paychecks to offset any of the tax that they owe, but it also covers some of those refundable credits. And that's the meat and potatoes. That's really what we like to see. We like to see these amounts high. So to start with the additional child tax credit, it's for filers who have the above and beyond the refundable amount of the tax credit. If they've received all the amount that they can and have reduced their tax that they owe to zero, they can receive a portion of the child tax credit as a refundable credit. Also, a portion of the education credits, $1,000 of it is refundable. The first $1,500 are not. So again, it's just trying to bring that tax owed down to zero, and only a portion of it can be refundable. Again, the program automatically calculates all this, so there's not any extra forms you have to fill out in the refundable versus non-refundable tax credit sections. If somebody is under the age of 24, it's refundable for part of it, but it's not available for a taxpayer that doesn't pay half of their own expenses. So the earned income tax credit. So there's a lot of little rules to this or things to keep in mind. So I'm going to cover that right now to make sure that you understand that. As always, your publication 4012 has some great information, some really good decision trees and ways that they've laid out the information to make it really easy to work with. You'll have plenty of practice with the earned income tax credit going through your practice modules, so don't worry about that. So if somebody is, if you're looking to see if somebody's eligible for the earned income tax credit, first you have to understand that they have to have social security numbers. So they can't use a social security number with not valid for work. This only comes into play for people that are applying for citizenship, and we don't see a whole lot of that at our tax sites. I know it sounds very obvious, but you have to have earned income. You have to have wages. I can't tell you how many people come in and expect to receive the earned income tax credit and they only have Social Security income. Again, I don't like to make people feel stupid or to be condescending, but it's only for people with earned income. That's why it's the earned income tax credit. So like I said, when I began talking about this, it's to incentivize work. So it has to be somebody that has wages or self-employment income, some sort of earned income. The person cannot be a dependent, so they can't be claimed on another tax return and then go to apply for the earned income tax credit. The person also has to be over 18, or I'm sorry, over 24, unless they have a dependent. So if they have a dependent, if it's a working mom that's maybe 22 years old, she's going to be eligible for the earned income tax credit. However, if it's a working single person that's 22 years old, they will not be eligible for the earned income tax credit. The investment income in the household has to be less than $3,350, and there can't be any foreign income. I haven't ran into this once in the 4 years I've been doing taxes, so I wouldn't worry about coming across this at the tax site. The filing status must be single, head of household, or married filing jointly. So if the taxpayer is married filing separately, they cannot, they definitely cannot do the earned income tax credit. They're automatically disqualified. And so if you're going through that situation with someone when they come in to start filling out their tax return and they indicate that they're doing the married filing separately status, again, this is just one of those jumping off points or things you can mention. That's one of the disadvantages to doing the married filing separate tax status. So the person must meet certain income guidelines. They can't exceed a certain income. And it's basically a ceiling as to the amount of income a person can earn. The higher the income, the less the credit. So there's really a sweet spot for somebody, and it really depends on household size, the amount of dependents they're claiming. There's a lot of different qualifying factors, so I can't just say that it's one thing, but know that the tax software will calculate all of that. If there is an earned income tax qualifying child, the child must have a valid social security number. They must be related to the taxpayer and they must pass the residency and age tests. So again, the dependent must be a resident in the home for at least half of the year, or at least more than half or more than 6 months. And they must be either under the age of 19 if they're not in higher education, or if they're in college or some sort of higher education program, then they can be up to 24 years of age. They must be a relative of the taxpayer, and the taxpayer themselves and the dependent must have lived in the U.S. for at least half the year. So if any absences from school or medical, or if they've gone missing, the taxpayer can still claim this dependent for the credit. Again, there's that age test. And then they can't be claimed by somebody else. So the earned income tax credit can't be claimed by anyone else. And so it must pass the no supports test if they're trying to claim the earned income tax credit. The child the child can provide half of their own support if it's Social Security. And then the taxpayer does not have to provide half of this. So the earned income tax credit, we're going to first start with some information if the earned income tax credit is being claimed by somebody, by a taxpayer with a qualifying child. So the child must have a valid Social Security number, and the child must also meet the relationship test as well as the residency and age test. The relationship test is obviously just that the child is a dependent and relative of the taxpayer. They have to have lived with the taxpayer for more than half the year, as well as lived in the U.S. for more than half the year. If there's a dependent that has had the absences from school or medical or is missing, or there's a situation of death, the taxpayer is still eligible to claim this dependent for the earned income tax credit. Under the age the dependent must be under the age of 19 if they're just in high school or grade school, and they must be under the age of 24 if they're a full-time student who's going to a higher education opportunity, or if it can be a disabled person of any age. And then also that cannot be claimed by anybody that doesn't have the that doesn't pass the no support test. So it can't be claimed by somebody that's not providing half the support for the child. The earned income tax. So the rules are a little bit more simple if the person doesn't have any dependents. So if the person doesn't have any dependents, they just have to be between the ages of 25 and 65. So just keep that in mind. I have had times where there's been people that are working and they might be 66 or 67, and I can't figure out why a credit isn't being calculated. It's because of the age. And again, I might have somebody in front of me and I assume they're 25 and older just by looking at them. But if I go back and check the year of birth, I realize that they might be 23. And again, that's why the credit isn't calculating. So do keep that in mind. If somebody is filing for the earned income tax credit, just make sure that they're not being claimed as a dependent on another tax return. It's eligible for couples that are doing the marrying filing jointly, but not to anybody that's marrying filing separately, and they have to have lived within the U.S. for more than half the year. So this is just a table to show you what the amount of the credit is. Again, the program will do the calculation all by itself, but as you can see, the credit is really most advantageous for families. So if somebody is just a working adult, their earned income tax credit is only a maximum of this amount, and then if they're earning above a certain income, they're not going to be eligible for any of it. They may be eligible for a portion of it, and you'll see these amounts will decrease for the maximum amount of credit based on the number of children in the home. It'll decrease based on the income and how high the income is. So there's a couple of worksheets I just like to keep people posted. There's some of these credits do require some additional sheets you have to open. If you go to the credit line on your 1040 pages, so either page 1 or 2, if you go to that credit line and see that there's already a number there, then that indicates that the credit's calculated automatically by the program. If there's not a number there in one of the lines that you think it should be, click to the right of the line and open up to see if there's a form that you have to fill out. A lot of the time that's the case. These two forms will automatically highlight if you indicate that there's either a dependent in the home, or if the tax program picks up on the age of the person that's filing and the amount of income, it'll determine that the person is eligible for the earned income tax credit. So you'll just want to fill out this information. Some of it's auto-populated, some of it you'll have to answer these questions. Again, this is a lot like the college or the education credits. I would take time to start reading through the scheduled earned income tax credit and the scheduled earned income tax credit worksheet, and really understand the questions that are being asked the first couple times you go through some practice problems. And that's just so you get familiar with the forms and understand what to fill out where. Again, on the worksheet, all of this highlights red if it shows that you have to answer it. So these forms can be a little bit confusing, but it's telling you where it wants information filled out. So just read the questions and it'll be pretty easy to understand. So I know I just covered a lot of information about some of the tax credits, so make sure you go through your resource guide, your 4012, and look at some of the practice modules, because I think as you go through some of the examples, you'll really get to see how some of those credits work. And I try to do a good job at moderating and letting you know why I'm putting information where and how it works within the tax software system. So some finishing touches: if somebody owes an amount due, so you prepare the tax return and there's not a refund, there's actually an amount due, people have a lot of different options as to how they want to pay it. They can either use a credit card and enter that information over the phone. They can pay by check. If you once you print the tax information, it'll print out a little voucher form that the person can just send in. So we can file the return electronically for them, so that the IRS receives it, and that way they don't have to mail in a bunch of different papers. They can just send this little voucher form with a check right over to the Treasury Department. They can pay directly online with an online payment agreement, and then they can also have their funds electronically withdrawn. A lot of the time, the client just wants to call the Treasury Department, so they'll indicate to you that you can go ahead and submit the e-file, and that they'll contact the Treasury Department about making a payment arrangement. These are all the options, so I'd just like you to know that. If somebody owes, just let them know. Try to identify why they owe. Sometimes it might be just they didn't have enough withholdings from their employer. 9 times out of 10, that's the reason. I'd say about at least half the time, if somebody comes in and they owe a significant amount, more than half the time, I'd say the client knows that and they're already prepared for that. So it's not like it's some huge news to them. And they understand that. So just let them know that they can change any withholdings with their employer on what's called their W-4 form. Also, if they owe, maybe make a suggestion that if they're retired and they're receiving several different distributions from investments and pensions, that they might just want to have a W-4 W-2P form filled out or one for their pensions filled out, and they can contact their broker or whoever their company is that's providing the pension and have the amount changed. What that does too is if somebody owes, they're also penalized because they should have been paying this tax throughout the year. So in order to let people know, and just as kind of an education piece, I make sure that people are aware of that, and that kind of spurs them to make a change on that W-4 form, because I hate to see people be penalized on money that they already owe the IRS. Let's try to provide some solutions so that they don't owe even more or owe in the future. They can make estimated payments as well. So if somebody receives a lot of investment income and they know that they're going to owe at the end of the year, it's a good idea for them to do what's called an estimated payments form. That's something they can set up with a Treasury Department. And basically what happens is the person sends in quarterly payments of tax, and then that way they avoid paying any of those penalties from not having paid taxes throughout the year. So they may owe at the end of the year, maybe a small amount. They might get a small refund if they do the estimated payments. But what that does is it makes it so that they don't have a penalty just for not paying throughout the year. So this is what I really like to talk about, the refunds. That's the best part. We have a page that you can hand to the taxpayer as they leave that provides instruction for them so that they understand how to check on the refund. There is a way to do that both for the state and the federal tax returns, and we do have a nice information sheet. So there's a couple of options if somebody's due a refund. They can receive their check in the mail, which can take anywhere from 5 to 7 weeks, and these are general IRS numbers and estimated schedules. Or they can have direct deposit, and we just need their bank information, so the routing number as well as the account number. It can go into checking or savings, and we highly encourage direct deposit options. We always have some sort of a debit card option available at the tax sites. However, people don't usually respond very well to this, but I do like to make sure it's an option for people. We also encourage people to use what's called a Form 8888, and that's if somebody wants to split their refund between their checking account and savings account, or this is the form that they can use to use their tax refund to buy a savings bond for themselves or for a dependent. The form is really easy to fill out. You just designate if it's going to checking or savings and how you want the refund split. So those are the different options if the person is due a refund. So some of the things you just want to keep in mind when you're finishing the return is the quality review needs to be completed. So you're all done with your tax return. You've reviewed it, you've gone through it one time, and then you have your site coordinator come over and complete the quality review. The site coordinator may go through some questions with the client if there's any questions that the site coordinator has, and then confirms information to make sure that the taxpayer understands as well. And then the taxpayer and through this quality review process, the taxpayer's identity is verified. Some of the things that the quality reviewer is looking for is to make sure that the tax preparer is certified to do the return. They'll go through the intake and interview form and make sure that any of the unsure boxes are have been checked to yes or no to make sure that all the questions that the taxpayer may have been answered. They'll go through the information on the pages just to verify that everything looks correct. Usually you can start to tell by somebody's income if they're qualified for certain credits. So that's just another thing that the quality reviewer is looking for. They'll double check to make sure that Social Security numbers, ITINs, EINs, that all the numbers are transposed correctly on the tax return, that the filing status is correct and that it's been verified with the client, as well as all of the dependents in the home, and that all the dependent information has been correctly entered into the tax return. They'll go through and make sure that all income sources have been included, that all the adjustments are correct. They'll verify the standard versus itemized deductions. They'll go through and verify and confirm the credits that the taxpayer is being generated refunds for. They'll also look at the withholdings and just verify the information from W-2 forms. They'll look to make sure if any estimated tax payments are present, that those are reported accurately. And then also they'll verify to make sure that the debit and bank information is on the tax return correctly, because that shows up in a lot of different places on the tax return. They'll just have the conversation with the taxpayer that the taxpayer is responsible for this information, so that it's important that when the tax preparer comes back and sits down with the client, that the client understands everything that's on the tax return because they're responsible for it. When you print the return you'll print the return for the client so that they have a copy of everything. And when you print that, right after all of the federal tax forms are printed, this Form 8879 is printed. We need to see that the client signs it. They have to physically sign this copy, and what it does is it provides consent for us to e-file their return, and it also indicates that we've reviewed the information on the return with them and that they're taking responsibility for all the information, that we've just prepared it and that they're responsible for the information on that tax return. Finally, just make sure that you ask the taxpayer if they have any questions regarding their return and that you'd be happy to answer them. Provide them that information sheet that shows them how to access information on their refunds so they can track their refunds at 48 hours after we submit them. And it's important that people know this and understand how to do that because otherwise they're going to be calling me, the program coordinator. And because I'm at the tax sites all tax seasons, I might not get back to them for a couple of days, which can be very frustrating for the taxpayer. So just make sure they understand how to access that and that we will not look up that information for them. Put all this information in one of the envelopes that are available at the tax sites. The tax envelopes are provided by the IRS. Again, on that IRS envelope, it gives instruction on how to access the information for tracking their tax refund, as well as gives information about their taxes. Thank the client for coming in and identify the status within the software to make sure that you indicate if it's a complete return. If it's not a complete return, indicate that, and use the taxpayer diary to identify what is going on with the tax return, if the client is going to be back in or why it's not ready. After all of that, you're ready to start a whole new return. So this is the end of the modules. Make sure that you watch the Affordable Care Act module so that you understand the insurance aspect of this. It's not very complicated, but it is important that you understand all of the Affordable Care Act information that we as the tax preparers have to input and have to understand and explain to the client. Also, make sure that you watch the module on state tax returns. That's another really good one, but very easy. And then the biggest one that you're going to want to spend a lot of time with is going through some of the example modules that's showing you how to use the TaxWise software and work with the 4491W examples. Those are great examples and great ways for you really to put all this information together and see how it fits and connects as a big puzzle. Thank you so much for your time. And as always, if you have any questions, make sure to contact me, Amanda Grover, the program coordinator, and I'll be happy to answer anything for you. Thanks.